Hi everyone, welcome to another market talk. It's been a while, glad to be back. Interesting 2 weeks in the markets. Hard times for bears, or maybe actually good times for bears. I'm sure we will discuss about that. So let's start. So Brian, what do you think? What is going on in the markets? What are you trading and what are you looking at?
Yes. Sorry about you were cutting out there a little bit. I'll get going here. So, or maybe it's me. My internet might be a little off. So if I have internet issues, just let me know and I'll pause it and try to figure it out. Can you hear me okay, Vi?
Yes.
Okay.
Can you hear me?
Yes,
Awesome.
we're good.
Yeah.
All right,
Okay, continue.
All right, let me share my screen here and I'll get going. All right, can you see that okay? Yeah. All right.
Yes, correct.
Great. Okay. So where are we? So 2 weeks ago, that was March 16th, we were just coming out of the banking issue. And just a reminder, like I've been super bearish since February 2nd, bear capitulation day. The expectation was for the economic data to continue coming in hot and spiking Fed hawkishness. On March 8th, we got to the point where it was an 81% probability the Fed was going to hike 50 basis points at its most recent March meeting. And then subsequently, the banking stuff happened, volatility blew out, credit spreads blew out, and everything got messed up from a bear's perspective. So a lot of stuff changed on that day. It was great to be short the Russell and short the S&P into this move, but that was the end of the move. And in the end, the freaking banking issue that causes everyone to short the whole and bid vol is now the catalyst that causes the bear market rally. So at the last meeting, the bet was VIX going to get to 40? I wasn't sure. I leaned on the side of no at that point, but right after that meeting, we hit Thursday, and a lot of stuff changed for me on Thursday of that week. We if we look back there, this is what correlations are right now, but stock bond correlations blew to like the most extreme negative levels we've seen in this entire bear market. Stocks and bonds were trading completely negative. So that's bonds up, bond yields down versus stocks down. We were trading deflationary risk off, which really messed things up. And then with bonds holding a bid like that alongside vol being bid so hard, that was very supportive for stocks. And what we also saw was what was being priced into like Fed fund futures. The expectation was for either a cut or no hike at this most recent March meeting. Expectations are still very low for that going into the next meetings from here. But the bond market had expectation that more banks were going to completely blow up. That's how it was positioned for. And that's what needed to happen. And so what actually ended up happening then was the long-term ranges on the indices. So if I look at like Russell and S&P were the big ones, we got to the point where the long-term downside in MFR was at 0% excess. So that means the bottom of the near-term range was at the bottom of the long-term range. This was on Thursday after our most recent meeting. And the same way I used that as a trigger at tops, to where if the top of the near-term range and the top of the long-term range are together, that's a signal that we're likely near a top. It's the same thing at the bottom. And so that was a big red flag to me that, okay, so the bond market is currently pricing the fact that stocks are going to completely blow up and the Fed's going to start cutting super hard in order to get bonds higher. And that would have to come, though, with more downside in stocks. And that was not possible because of the fact that the long-term range was completely capped down there. So you had bonds expecting one thing and the possibility that was going to happen on stocks as highly unlikely. And so that then in conjunction with VIX being bid up very aggressively, we had IV ranks on SPY, QQQ, and IWM all above 50%. We've seen them higher. Like this really wasn't that big of a bid for vol on this move. It was actually kind of depressing. Like on Thursday when I saw the long-term range cap out in conjunction with what I knew on correlations being negative, it was really sad because I thought that we'd maybe get more downside for some of the puts I had and some of the short stocks, but this move just was not impressive at all. And as soon as I saw that long-term range cap in conjunction with the correlations being negative, I started covering shorts very aggressively. Quite frankly, I started getting the signal on Friday, March 10th. That's when correlations started going aggressively negative. So I started covering here. I covered some more on Monday. I wish I would have covered the puts and everything on Monday as soon as I had, but I kind of hung around a little too long. And on Thursday, I was kind of here. I was sort of hoping like, oh, maybe correlation would change. Maybe they'll re-strengthen positive. Maybe we can go a little lower. And it just wasn't happening. Correlations were remaining negative. Nothing was changing. Thursday, we had that big squeeze. And then that was also the same day that we had the long-term ranges cap out. And I was like, man, I need to get out of these positions ASAP. And so then Friday, luckily we had a small dip and I exited pretty much all of my shorts on Friday. So the course of this week, I was degrossing. There was nothing telling me that you would continue shorting around here. So I really didn't short any stocks during this week at all. I was degrossing here. And then once I degrossed there, I was looking at some long spreads. So the one that I have entered is IWN over QQQ. If you look in MFR, so actually let me pull up my fractal range. I'm sure you'll probably do a little bit too, Vi, but I'll just pull it up as well. If you look in MFR, what I like in spreads, I did this with XLU, IWM, and it worked great, which I exited that one as well, but that one just ripped as soon as the banking stuff started going. It was awesome. But you look at IWM, I like long-term, like the spreads I like getting into that works with XLU, IWM. I'm trying to do with these two. They're bearish trend, but they have just an insane amount of long-term upside, long-term upside downside ratio. And then the bottom of the near-term range and the bottom of the long-term range are the same. So right around here, I entered in the IWN over QQQ spread. I have one more bullet I can add to that spread if we go a little lower. But the expectation around that was that this spread just got completely whacked in the banking stuff. Like Russell started underperforming before, and then it really got hit here when we started trading deflationary risk off. And so I think it's highly unlikely that this spread goes lower and Russell underperforms Qs that much harder from here. So we'll see. I still have that one on, and I'll look to add more as well. And the idea behind all of that is just the fact that, again, the reason I was short to begin with into March, I wasn't some guy that said they called the banking issue or anything like that. Like the data continued to be hawkish. Like none of the data that we've gotten in from a macro perspective, and this is just bean counting, it's no forward-looking models like that, but it's just tracking exactly how it's come in. All of it's hot. All of the data has been hot. Like there's no recessionary data at all that's coming in February, and thus far the March data, housing market is still bouncing. The PMI reports last week were strong, and then we get ISMs next week, which services are up 2 months in a row. Maybe it'll be up for a third month in a row as well. Like all this stuff is not saying there's any kind of recession that we're in right now. And so under that expectation, I would expect bond yields to continue being supported. And so if you look at like the 5-year, this one bottomed, it was doing a bottoming process as soon as we got to the point where stocks weren't going to go any lower, which is the same idea. Or for bonds to go higher, at that point, stocks had to be able to go lower. And now we've bounced back up and we're trying to go higher. Next week, we have the PMI reports to support us there. And what we've gone to from is that stock bond correlations were deeply negative during the banking issue. Now that's starting to revert. And so what I identified was when stock bond correlation is very negative, we got into a situation where good news was good news. So bailouts, solid job reports, good PMI reports that the economy isn't in recession. Initially, that was good news where you'd get bond yields up and stocks up. Now, and we've started to see it over the last couple of days, which is a very good sign, stocks and bonds are starting to recorrelate together. So for example, today, TLT closed green, SPYs closed green. So that was a great sign. I want this to continue if I'm going to get bearish and short again. This is still pretty weak. I need these correlations to get more aggressive, and then I would look to short. I'd also want sector correlations to re-strengthen as well. Both yesterday and today, those remained pretty weak. So broadly, from a correlation risk perspective, we're not there to short yet. This is very supportive for markets. It's been supportive for the past 2 weeks. That's why I haven't been shorting the whole. And that's why last week I was like, this thing's about to rip. And you see my little confidence score, I went positive on it. So correlations are not there for us to short. Trend range perspective, we are getting some separation from the bottom of the long-term range. So now the trend skew on SPY is neutral. So this is a positive development that wasn't there last week. And so that's a good sign. And then lastly, if we look at the gamma ranges, the gamma structure for SPY, above 400 absolute gamma, anything above 400 is very supportive. So today, like we went up to the 405 call wall, almost got there, rejected back a little bit, but we remained above 400. One standard deviation move wouldn't have even gotten us below 401 today. So there's really no chance that we'd break down from that intraday sell. But broadly, the market is very well supported above 400. Correlation risk is not aggressive enough to break us down. We're not really towards the top of the long-term ranges on any stocks or bonds either. So yeah, it's really not looking good for shorts. It's looking better than it was 2 days ago, but I'm not gung-ho, super confident on shorts here. What does give me some hope is vol. So vol is getting just absolutely spanked. If we look at SPY IV rank, it's down to 16%. So that's if you look at from 0 to 100%, 16% where it was over the last year. It's towards the bottom of where it's been. IWM is well bid in terms of vol because that's the one that got hit the hardest in the banking issue. So I wouldn't do puts on those. So I like QQQ and SPY puts is what I'd enter if we do get a chance to buy those puts over the next week, but not yet. The only shorts that I'm most confident in here is gold and silver, especially into next week's ISM reports. And that's because I think they're going to continue coming in hot. And if you look at the long-term range in MFR, the same way as the downside was capped on stocks. And by the way, the downside was capped on gold too, but I was super greedy with the short and I held it throughout that entire squeeze. But the gold actually, looking backwards, of course, gold was a forward indicator for what was about for that we were about to go into a deflationary risk off event. The excess long-term downside in gold was 0, and the excess long-term upside on dollar was 0 as well. So both of those were actually a signal, not necessarily for a bear market rally, but actually that we were about to go into a new regime temporarily. But now gold is capped to the upside, and so is silver. So I'm super short on these because they're pretty much the only shorts I feel confident in shorting right now. I'd rather be short gold and silver in size than I would stocks right now. And maybe they both would work from the short perspective, but gold and silver have a chance of working with stocks continuing higher with a little gamma squeeze into quarter end. So that's where I'm at, Vi.
Yeah, I also want that stock bond correlation to continue in a positive way. But of course, from market direction, I would like it to do exactly the opposite, both go down. But of course, we are not here. So if we are talking about correlation, so I'm sure today this topic will take most of the time of the show because I know that it's interesting also for our users. But so Robbie, let's continue with you. So first, let's talk about what you see in the markets overall, what you are doing, and then I will touch a bit on correlations. I'm sure that you have interesting points on that also.
Sure, thanks, Vi. Can everyone hear me?
Yes, we can.
Okay, so I'll share my screen as well. Right now in the markets, I'm trying to keep as nimble as possible. And not much confidence at the moment, kind of resonating with what Bryan said. Last week I talked about, and can everyone see this chart that I've got up?
Yes, we can.
Okay. the spread between implied and realized volatility into the March lows. What was happening was that spread was blowing out. It blew out to about 11 points. Since then, and into the highs yesterday, into the highs today, the spread has basically completely narrowed. So depending on how you measure realized volatility, there could be a couple points difference, almost no points difference, or a negative spread. So the one way to measure it is through an exponential weighting. So that weights the more recent data points heavier in a 21-day calculation. And that's at about 16.67% compared to a VIX at, I guess, around 19 today. Yeah, closed 1902. And then you can also measure it with, let's see here, just the classic close to close measurement. So that is 18.41 points. And then lastly, well, those are the two charts that I've got up. But if you look at intraday measurements, it's around 19.5%. So now there's basically no volatility risk premium. Again, depending on how you measure it, it's almost negative. It's not a great time to keep shorting vol if anyone was thinking about that. It'd be probably the worst time to short vol. Yeah, so that's the biggest thing I'm keeping my eye on. I think it's the biggest risk when that spread goes negative on a sort of average basis, forward looking over the next 60 days for SPY. Although that's, again, just one thing that you would want to keep into your process or into consideration in your process. And then Vi, you asked me to talk about correlations as well.
Yeah, I know that you are using them and you have interesting ways of interpreting them. So yeah, I just wanted to ask you more about correlations, how you view them, what signals are you taking from them, and yeah,
Sure. Okay, sure. So Brian brought up sector correlations briefly, and he said they weren't really like getting to that level where he thought it would be a good entry point for shorting potentially. This chart basically shows you sector correlations, an average of the sector correlations over the past year, I guess. And each label on the y-axis is just like a 10-day period. So here would be like a 10-day correlation, here a 20-day correlation, 40, etc., all the way up to just under 200 days. And just behind or in front of the correlations, the price of SPY is overlaid. What you can see in, and the reason I present it this way is because it gives you a good idea of sort of the landscape of the correlations over multiple timeframes. So it distills a lot of data and presents it in an easy to digest way. So going into February, we had basically hot correlations, so between 0.7 and 0.8 on all timeframes. And then into the highs here, we kind of like sharply dropped off on the near term. And even into this first March low, we dropped off even more heavily in terms of correlations. And we only slightly heated up here into the ultimate lows from a couple weeks ago. As of yesterday, we have spiked back up to 0.62, and I don't have today's reading yet, but I imagine it's around the same level as we didn't do too much directionally today. So another reason I like to show the chart this way is because I like to see which parts of the chart are disagreeing with each other. So right now, basically, it would be saying that sort of this short to intermediate term are disagreeing with this longer term correlation. And same with here, this short time frame we had during the summer of 2022 was disagreeing with this longer term correlation. There's lots of periods in time where you'll get a single color across all time frames. A good example is probably for most of 2021, we had lower correlations for the most part. And again, 2017, this was all blue across all time frames. Bryan mentioned he was like very keen on looking at correlation extremes. So when I look at this, I really only, if I'm looking at it on an absolute basis, I do really only care about correlation extremes. And there's two charts that I have to show that. So this is a chart that shows the relative mean return on the S&P 500 broken out into correlation deciles. So here you have your lowest correlation between sectors, and here you have your highest correlation between sectors. And so the highest quantile or decile has the highest relative mean returns to the SPY. This is your y-axis, which is showing 4 days. So between 10 days here and 60 days forward returns on the SPY. So a 3% return here would mean it, when you're in this quantile of correlation, that this SPY is returning 3% in excess of its normal mean returns. And then here, when you're in this lowest decile, you're sort of returning 2% negative in excess of the average SPY returns. Now we're kind of in this no man's land. And so it's hard to use correlations on an absolute basis when you're just in this like mid-range. And that's when you can get more signal out of them by using them as a basis, sort of like how Vi likes to use, and Bryan, different ratio spreads between stock tickers. You can do the same thing with correlations to other indicators. And even though you might see this sort of mean return that has no signal at all, you might get something else when you use them as a basis. And then finally, one more chart on what correlations mean on an absolute basis. This is the same sort of idea, except instead of forward returns on SPY, we're looking at the forward realized volatility by quantile again, and again over 10 days to the next 60 days. So when you've got correlation in your highest quantile, you're realizing over the short term an average of 30% volatility. And then when you've got it in these lower deciles, it's really a low volatility environment on average. And Vi, that's pretty much all I've got on correlation for now. If you have any questions, let me know.
Yeah, thanks for that. Very interesting. So yeah, basically, you mentioned a couple of similar ways I view that. So, for example, this current signal where we are at, usually I call it a chop market. So, of course, correlations is not the only signal, but yeah, absolutely, I agree that for now we are. It's very hard to be confident in going to any directions in the market. But overall, can you just talk a little about the signals you receive? For example, you talked about extremes. So let's say that during periods of very strong average sector correlation and during periods of relatively weak sector correlations, how people can use that for their risk management and portfolio management, maybe. So just in a very, very simple way, what signals can correlations provide for people?
Sure. Let me think about that. So the way I think about correlations and risk management, as a general rule, is that higher correlations means higher risk. And that's pretty much exactly what this chart is showing. It's showing you that when sector correlations are between 0.81 and 0.96, you're going to realize the most volatility over the following you know, 10 to 20 trading days. And then compared to all of the different quantiles here, you're still going to realize the highest volatility over the next 60 trading days. However, that has been also the best time to buy the dip on SPY, which is what this chart is showing. If you can handle that risk historically, you'll get an excess of 3% returns over the mean SPY return, which is around 3% over the next 60 trading days. I don't really think that this is going to be representative of the sort of distribution to come over the next, 10 to 20 years. I think this is just like a function of the last 20 years where we've been in this massive bull market, and every time we have any sort of carry crisis, the markets get bailed out. I think that's really what this is showing, rather than a signal in itself. I think that the main signal that you should take as truth from correlations is that higher correlations represent higher risk on average. There is a couple periods in the data sets where low correlations represented higher risk on an aggregate basis. And those were in the period of sort of 2000 to 2002, as well as last year. And that was driven by the NASDAQ pulling down the major indices, while everything else kind of like ignored it. Does that help, Vi?
Oh yeah, totally. I always wanted to talk about that with you because we receive a lot of questions about that, and I just wanted to hear a different perspective, and absolutely agree. The main issue that yes, higher correlations mean higher risk, but a lot of people don't think of risk. That risk can be both to the upside or to the downside. So exactly like you said, if you can handle that, and also when correlations are at its extremes, both on a weak side or on a strong side, of course, they will not remain there for forever. So it's a really great tool for risk management. Thanks. I'm sure we'll continue after recent Ramadan has their. So okay, let's move forward with Christopher. So Robbie, you can now stop sharing your screen.
Okay, thanks so much, Vi.
Thank you. And Christopher, so what changed from a macro perspective? What signals are you seeing?
Oh, do you understand me? It got a bad connection signal, I think.
Yeah, at least for now, yeah.
All right.
Okay.
All right. All right. So,
Robbie, you are still sharing your screen?
I'm actually not sure how to stop sharing.
There is this green button, I believe, where you press to share. Oh no, red button.
Robbie,
Stop sharing. Yeah.
Yeah, on one of your screens there'll be like a drop down, like towards the top, that like.
Oh, okay.
It moves around.
My screen.
Yeah.
Got it. Okay, thanks.
Okay. Yeah. So Christopher, so macro.
So yeah. All right. So I prepared some slides. So I wanted to focus on Europe. So for Robbie, I like to use macro regimes as a trading or basically as a asset allocation indicator, where I try to assess growth and inflation probabilities from different perspectives. So I like to focus on Europe because I think that there are still some issues with inflationary pressures, which keep building up. So in Europe, we're having on a weekly regime probability, we're currently in reflation, based on my model assessments, which is kind of supported if you look at the City Economic Surprise Index, because data is still relatively hot and the labor market is still pretty strong. currently. Where we got Germany as well is showing some decent growth probabilities. That's one reason I think that the DAX corrected upwards again from the recent sell-off. As well in Spain, we're seeing some real growth. Italy is currently in disinflation. Belgium is in stagflation. Denmark in disinflation. Greece as well in stagflation. Netherlands are currently showing a real growth regime, which is not that dominant because disinflation also has 43.2%. So there are kind of some mixed signals all around Europe. But basically, I like to look at Europe as a whole, or basically the Eurozone as an indicator for general perspective. So Europe currently in reflation. We have some very high inflationary pressures if you look at the probability assessment. So inflation probability is at 91, at basically 91%, which shows that there might be some surprises in the next CPI reports. Then I would like to move on to what I already mentioned. So you can see the City Economic Surprise Index in the blue line, which is still positive on a very high level, and this has a very strong correlation to the reflation probability. So each time this indicator move upwards, then the reflation probability also increases, and the correlation is about 0.4, which is basically really strong if you look at macro data. So this is a good indicator to watch if there's some changes in the incoming data. And as well, in the yellow line shows the inflation surprise index. So this basically measures the surprise of each inflationary item which comes in, aggregates them. So we are seeing that, as you kind of know, in 2022, this thing ramps up to over 250, I guess, to 270 it tops, and then it corrected downward. But in February, it also moved back up again with a decent jump if you look at it in first difference measures, which shows that there's still some decent inflationary pressures in the Eurozone, even with this high CPI numbers. Inflation is still very persistent in the Eurozone, so which translates into the bond view to basically see a hawkish ECB, which tries to raise rates even more than the Fed will maybe do or maybe don't. So this is currently the growth and inflation view for Europe. And if we look at the PMIs, they also corrected upwards. So we're seeing that some moved above the contraction line, which is at 50, which also shows that we are not at recessionary levels, even if interest rates signal something else. Based on the hard macro data, these indices show that we're far away from a deep recession currently in Europe. So all of these showed some uptrend in the last 3 to 4 months, which shows some positive economic momentum currently. This also supports, of course, equity prices in the medium term, in my opinion. As well, if you look at some confidence indicators, you can see the consumer confidence, industrial confidence, retail confidence, economic sentiment indicators. The only indicator in this chart which is at recessionary levels is the consumer confidence indicator. This is the blue line, which is currently at -19. All other indicators, they showed some decent downtrend, but then corrected or showed some decent positive momentum in the latest months, which also supports the reflationary regime in Europe and especially in Germany. Which also, if I look at my macro signal strength indicators, are supported by my momentum measure, which I overlay, or basically I use the aggregated data for my regime probability calculations and try to assess macro momentum, which is basically a simple function of a series of higher highs in the equity, the equities, or in the basically in stocks, or if you look at DAX. So basically all across Europe, we are seeing some good momentum based on the recent macro data, where I would like to think that it's not the time for a decent correction for now, based on these indicators. So yeah, that's the view for Europe. And then I did some calculations on where we are in the valuation cycle, and I tried to assess some simple valuation models, which is the slide after that. So here you can see, for instance, the growth probability in Germany, which is moving up again from a recent correction, which was during the banking problems in the US, as well. You can see Europe, which also corrected a bit down, but is still showing some decent strength. So now to the valuation part. So it's a simple valuation model for the US stock market on the left side, which I try to assess the fair value in some kind of way by looking at earnings, free cash flow, and sales. Use a Bayesian analysis and overlaid it with some confidence intervals. So even if valuation is not a decent short-term indicator, it gives a feeling of where we are in the current cycle. And for the US, we are currently at mean outcome. So based on the current earnings and basically assessments of cash flow and sales, SPY is reasonably priced, in my opinion. And on the right side, you can see the small cap index, where you see S&P 600, which is mispriced based on this model. This also tends to agree with the view of Bryan. So basically, on the medium term, your IWN QQQ spread should work as well based on valuation. So we're below the lower 90 confidence interval. So if valuation is a bit of a driver for future returns, so this should also support the view, in my opinion. Next, just to look at I did the same for XLE and as well for home builders. Yeah, so XLB is also reasonably priced. It's the lower 60% confidence interval, and on home builders we're looking at it's almost at the lower 80% confidence interval. So there's some in the medium term could be some upside if you look at it from top down. But momentum is also and correlations, as you guys says, is a more precise indicator as valuation, in my opinion. But for me, it's a general view. So another one is Europe and Germany. Europe is slightly overvalued. Germany is currently at mean outcome. So Europe, we're looking at Euro Stoxx 50, which is at the first upper confidence interval at 60%. So if you look at in a long-term view, there could be some downside if we get the regime switch into more a stagflationary or disinflation regime. So there could be some some opportunities in the medium term. So then I would like to assess Sweden again, because this is one of the most interesting countries currently, due to several reasons. The most dominant or the most important reason is private credit, which I wrote about on my Substack. So basically, Sweden has a private debt to GDP of north of to 30% of GDP, and this is not supported by government spending. So it's basically all of the liabilities are on the private sector side, which is basically not a good foundation if you have some variable floating rates and housing in the housing market, as well as refinancing needs for your private economy. So high rates should feed through this feedback loop, and Sweden is not aware of this problem, in my opinion. So stock market is overvalued. Performance does not reflect the macro signs. As well, we are looking at retail sales, which are down minus 10% year over year, which and measured the lowest number ever. GDP is projected to be right around -4 to -6% year over year, currently at minus 0.12, I think. So there's, in my opinion, this is one of the biggest opportunities on the short side currently available. And we're also looking at a growth probability, which is fairly low, and a recession probability based on interest rates, which is really high and keeps on moving higher, even if it's kind of volatile. If you look at 20-day average, it's upwards of 60, 70%. And yeah, I think this is, in my opinion, if the price index turns, this is a great opportunity to get into the trade. So that's everything for me.
Yeah, thank you. Really interesting. Ramadan, it's been a while. So what are you trading?
Yes, sir. It has been a while. Let me share my screen here. I really don't got that much, just a little update, what I'm seeing. What am I gonna do? All right, can you guys see?
Yes, yes.
Okay. So I am looking at the 10-year right now. I am on the opposite side of some guys on the call here. I'm actually long bonds and gold, and those have been working out for me. But on the other side, I am short some stocks, and that's starting to squeeze a little bit. I was short oil earlier last week, but with that big drop, I was able to get out, and that corresponded with the whole banking issue and the yields dropping. So I took that collapse in the oil like as a confirmation in the 10-year yield going down to let me stay long bonds. And the way I saw it as is the bond market is basically saying that there's going to be a recession. Nothing kills a recession like inflation like a recession, which is why yields dropped so hard, especially on the front end, which is kind of just playing into this deflation regime we've been waiting for, and why gold is really starting to kick in. With the lower yields, you did see Qs really rip, and I think that's because of the discount rate now is compensating for the deteriorating earnings that we're expecting. But when Q1 and Q2 starts rolling around next month, we'll start to see if the earnings really deteriorate, and then those lower yields won't compensate. We might see more selling pressure there. Again, on the yields, I'm looking at stuff like the global supply chain cost index, which was like a big thing for supply side push inflation, and that has come down to do I have it up here? That's come down basically to below COVID levels. So we're not gonna see inflation on that end. Oil, with the recession possibly coming, less demand for oil. So I'm the whole inflation thing and the higher yields, I'm starting to see we could be maybe like somewhere be stuck around like we're not gonna go back up to like 4 or 5% inflation higher once we get back down, I mean. So if the Fed is able to, control this inflation thing, we might be able to. I don't think that rates will go up that much higher. We might have topped out on rates, in my opinion. Also, if you look at the National Financials Condition Index, that's been starting to tighten up again all year after all of last year. It was just loosening. And next week, tomorrow, we're going to have a lot of economic data coming in with the Chicago PMIs, PCE, and personal spending. So, yeah, I'm just right now sitting long bonds, short and long duration, gold. The dollar has been kind of killing me lately. Not sure where if we're gonna bottom out anytime soon here or not. I might have to get out of this one, but yeah, it's just it's been not high conviction here lately for me. We are right at like near trend and trade resistance, so I'm going to hold these shorts for another day or two, see how the economic data comes in tomorrow, spill over into next week. If things are just keep going up, I'm going to have to start closing some shorts, but looks like the bond side will keep working for me, but we'll see about that. And looking at the stock bond correlation, everybody loves to talk about stock bond correlation or correlations in general. So this is SPY average sector correlations, and we could see that it kind of bottomed out and starting to increase here. This on a 30-day duration. So on this, I'm hoping, correlations are increasing. We start seeing that sell side move as correlations increase again. And this is stock bond correlation and using different durations of bonds on an average. And you could see it's really like come down, and we could see that's like back to, bad news is bad news or good news is good news, the negative correlation. So we'll see how that changes. This is again stock bond on a shorter, this is 30-day, I believe, and this is a 10-day. So yeah, we could.
We still see your trading view chart, I think. Is that the one?
Oh shoot! Am I not? Am I? Oh, good thing you said something, buddy. Okay, let me go back then. All right, you guys see the Python now? The script? Yeah. So, all right, let me go back then. So as I was talking about the correlations, I'm seeing here medium term stock sector correlation started to turn up a little bit. This looks like it might have been a little bottom, and hopefully like I'm expecting that sell side move with the higher correlations here. As I was saying, the stock bond correlation on different durations, we see here it's really flipped negative on a 30-day and on a 10-day. So hopefully that will work with my positioning in the portfolio of long bonds, short stocks, but we'll see. What else? And some CFTC positioning data. We have net positioning and open interest percentage. You can see we're at like extremes on oil. We are relatively flat on gold, which is making me hold still and not trim as much as I normally would on my gold positions. Dollar, I saw a Bloomberg article last week about hedge funds getting long dollar too soon. And I just don't see that in the data here. I mean, unless they're talking about this up move here, but I saw it like closer to last week. So looks like they're capitulating maybe, which would be good for long dollar positions. And here also you could see that long bonds, people are just really selling this hard, which also makes me just, by positioning, you want to take the other side of that. And SPY also. We got a lot of sell side coming in after that top move, but maybe a squeeze there to push us up higher. So I don't have too much conviction in my moves right now, and I'm kind of balanced out between my positions on long bonds and short stocks. But yeah, that's about it for me.
Interesting. I think that some correlations are already starting to go up. We'll see how it goes.
This is something
currently,
interesting, actually. If you guys still see my screen?
Yes.
So this is the CME liquidity tool, and it shows basically the book depth of E-minis, S&P E-minis.
Yeah.
And something I've noticed is every time you see like a big drop here, which is like no liquidity almost, you see a big move, right? So we had a big move up here after that short liquidity like crunch. And then we had the big sell side move down. Here we had another liquidity crunch. Liquidity came back and we jumped up and then went back down. Here I'm seeing something, similar. We had a liquidity crunch, a little bigger this time, and liquidity is coming back. And if you can see up here, it's like spiking. So is that a sign of a reversal? Not sure. Just thought this was something interesting to share with you guys. See if you guys had an opinion on that.
Yeah, I've noticed the same. You can calculate effectively like a proxy for this tool if you use the closing price change day over day, or the high and low price of the day compared to trading volume. That will kind of proxy your order book depth.
Right, right.
And you can notice on days that are ranking as near the top of the range of illiquidity, you'll often get bounces from that.
You're saying like when there's a lot of liquidity, you see a reversal?
Yeah, well, I think both are true. You often see bounces following extremely low liquidity days, and the converse is often true, though less reliable, that you'll get reversals off of extremely high liquidity days. And it depends how you measure liquidity. So the way I like to measure it is if you just take a close price to close price, you'll often see high liquidity days as very little close to close price, a ton of volume, but a large intraday range.
Okay, interesting. I'll have to look into that. But yeah, so you do see something here as a possible reversal also. So that's interesting. I'm curious to see what you guys think on the dollar. Nobody's really hit on the dollar today. What are you guys thinking about the dollar?
I will talk about the dollar a bit. So yeah, I believe, and Bryan mentioned that multiple times, that in the longer term, for at least for now, nothing has changed. In the shorter term, well, a lot has changed. So yeah, but first, if you have to say something about the dollar to continue, or what are your views on the dollar, Ramadan?
Oh, well, I mean, I'm long, but I'm like really close to getting out of this position. I'm just like, using this as like a last hope of support here. But if it starts breaking lower, I'm just gonna, throw my hands up and get out of that. And
Okay,
it would
so,
just work
yeah.
for my gold position too. Then my gold position would just more confidence in that then.
Yeah. Okay, so I will share my screen, and maybe then I will start talking about the dollar first, but anyway, so regarding dollar, I see a huge. First of all, I'm using futures, not spot rates, but they correspond to spot prices very well. So regarding dollars, of course, from a momentum perspective, yeah, we all know what happened and what is going on. But if we are looking for the longer term significant levels, I will short euro dollar at 1.1050 again. Of course, first, we need to reach that level. But why? Because if we are talking about things futures traders use, so like market profile or volume profile, I still see a lot of action order-wise on those levels. It worked last time. And from my macro view, like I said, still nothing changed. So I will short. For now, I don't have active position. Yeah, of course, I keep my cash and trading account mostly dollars. So technically, I have a dollar position because of being in Eurozone. But for now, I don't have active trades. But I will initiate if we see some. Well, one of the two. Some. Further upside momentum in euro dollar or reversal signals in dollar itself. So I'm preparing to buy dollars or you can say buy more dollars compared to what I already have. But I still think based on momentum perspectives and everything else I'm monitoring that maybe today is not the best day to do that still. I see short-term upside probabilities are not very huge. So first would be like 1.1050, 1.1030, and if not, well, then maybe 112 on euro dollar, something like that. And if we look, first of all, I wanted to start from different thing, but if we're continuing to talk about the dollar, so this is a SPY UUP correlations, and their regime is quite clear. Of course, when we will reduce periods and situation will be completely different. But I mean, longer term negative correlation is still quite strong, and even a 5-day change in that is also not significant at all. But what I would look at, so let's move to 30-day. And let's continue with the dollar. Yeah, so basically now on a 30-day basis, stocks and dollars has almost no correlations, and we can see that starting from December, that correlation went up, and of course that's not what we want to do, want to see, especially in this regime. So regarding dollars, of course, couple of things. So upside downside in ranges when we are talking about the future, significant levels on that are still higher compared to where we are now. Of course, reversal in correlations, and then overall market direction, because of course if for example SPY continues to rally, let's call it bear market rally or whatever, then that plan to buy more dollars can be a bit postponed. Anyway, so these are my thoughts on dollars. I would still love to see euro dollar above 110, not because I'm very bullish on euro, but because it would be a lot better spot to short euro against the dollar, of course. So I will not talk about average correlations. I think everyone already talked about those today. So I will just talk about what I'm mostly looking at first. So I'm not. I at the moment I can't be very confident about shorting the market. Also, of course, same goes to going long. I'm still in mostly in cash. It's like, I believe 95% is cash. I have a very, very, very tiny ES short position, and also a very, very tiny position of shorting TLT, but that one is even less size regarding bonds. It's like 50 basis points, and So we'll see about that. But so how Robbie already talked that higher correlations mean higher risk, and it's totally true. But again, I want to remind everyone that risk can be both ways. Risk doesn't mean that it's only risk to the downside, but it also can be a risk to the upside. So when the market is moving to the same direction, it can go up or down. So it all depends on other factors. But for now, from correlations, so if Bryan already mentioned what I really like today, if we go to 5 days, so of course this SPY TLT, because stock bond correlations were hammered, it was basically -1. And now basically, like Bryan also said, everything is starting to correlate, and same we can see on 10-day. Of course, it's still negative, but if we are looking on 10 days, I also want that to go up and to the positive territory. So from the short-term perspective, it's a very good sign. That's why tomorrow and on Monday I will be looking very closely what's going on in the equity market. So of course ES, mostly QQQ, IWM, and so on. But those correlations and how they are changing basically tell me that maybe we will receive some significant signals for the risk. Same goes to average sector correlations. Of course, I expect them to go up, because at least for now, well, when you look into different time frames, so if we are talking about very short time frames, the signal risk is still not building up, or even if it's building up, it's building up quite slowly. So what I wanted to show actually that for those who are trading spreads, that actually in those couple of weeks, XLU, SPY correlation, and also REITs is strengthening. That this is a 5-day change in this particular chart, but basically what I want, because REITs got hammered, and of course we know why. Banks have got hammered as well, but I still don't see any significant changes that would make me want to short banks now, because like Bryan said, when this banking crisis already happened, when we need to wait for clearer signals, because now it looks like we're chasing for something. But what I wanted to say, that maybe looking into pairs with REITs or XLUs in the future, maybe it will deliver good trading signals. So that's what I'm looking at. Basically, I'm looking to trade real estate versus something. And of course, that's something. It will not be individual stocks, but I have watch lists with all the sectors and so on. I expect those assets to be quite interesting. So yeah, so we all know what regime we are in, so nothing have changed. I was talking about the dollar, so I will still come back to this. So regarding stock bonds, for basically, if we watch a 1-year correlation, so it's positive and going up since November. So because it's 1 year, so you can add another year. So basically November 2021, if we start from that data, the stock bond correlations were strengthening and now positive. So this usually market trades this way in inflationary bear markets. So of course, for now, we know that some people say that we had inflationary bear market. I believe that we have and we will have an inflationary bear market. Nothing has changed, but basically my game plan from correlations perspective, I want them to go up and momentum to go down. So now I will continue with first of all upside downside ratios. So this is a window moved. Okay. So this chart will be a regular my fractal range upside downside ratio for short term. So probabilities are skewed, but for example, we see that SPY downside is finally bigger than the upside again. So upside downside ratio is below 1. So again, that is another reason together with SPY TLT correlations why tomorrow I will watch. Maybe I will add to my short positions, but of course, new day, new story. So first we need to see how market behaves tomorrow. And to be honest, the more it goes up, the better. Relatively, knowing that in a long run, at least for now, it doesn't change anything. But on the other hand, shorting Qs now looks quite suicidal to me, because if I had to choose, I would choose. Of course, IWM. Second would be SPY, but the problem, SPY, QQQ are still a relatively bullish trend. So shorting IWM can be even a good idea. But what stops me now? So this was regular ratio, but now we'll go to the longer term, basically. Yes, and longer term is here. Yeah, so longer term, and we see that basically equities probabilities are slightly skewed to the upside. So for swing trading or cycle trading, it's still signaling that for now shorting the market for the longer term is maybe not the best idea. So what are the good shorts? The ones that we don't want to short, of course. So VIX. Of course, things like this. Again, IWM is a great spot. So Bryan is trading XLU IWM. I think that's a great idea actually to look, or IWM versus QQQ. You guys already talked about that. Yeah, but basically, definitely IWM remains my one of the favorite equity related things to play on the short side. Basically, of course, XLY is really strong on the longer term. XLC, QQQ, well, you guys see that, okay. So now momentum. So we will start from shorter term and we will move to the longer term. So momentum score is also changing compared to previous weeks. So SPY is still positive, but the dollar is strongly negative, of course, no surprise. So I want to momentum to reverse from that. Of course, for first dollar needs to stop falling down for that. But from the momentum perspective, the only things with a good short-term momentum are things like XLE, XLP. Of course, silver is crazy. I think everyone noticed that. Use gold is not bad, and yeah, IWM is neutral for now. So also encouraging for shorts. What's going on a 30-day basis? You will see that on a 30-day basis. What's interesting? Okay, TLT is slightly positive. Dollar is slightly negative. But yeah, of course, financials, Bitcoin is doing quite well, gold, silver, etc. So when I'm looking at the combination, because I was talking all the time that for me, one signal is not a signal. I have a process, and I always say that you can't rely on something, either a Hurst exponent or range or trend or whatever. I mean, you need to have multiple signals confirming each other. So of course, momentum needs to reverse for me to play more aggressively on the short side. So yeah, basically, and on the trend side, this was highly requested for the last couple of months. I was not talking about that a lot, but from the strength of trend, so Hurst exponents, of course, my favorite measure to see if an asset is trending choppy or so on. So this is a short-term Hurst exponent. Basically, for me, everything above 0.7 shows a significant trending capability. So significant trend. So of course, what we see, of course, the trends in gold, even SPY, TLT, and dollar. And other assets, you can see the ones that above 0.7 are quite strong. So what I don't like here, that Hurst exponent on the dollar is very strong, and basically it gives the way I look at Hurst exponent, I was already talking about a lot, but basically it's a probability of tomorrow continuing to the same direction as today. So I mean, Hurst exponent of 73 gives a 73% probability of a dollar to go to the same direction. Of course, magnitude is not counted, so I mean it can be 1 basis point. But basically, that the directionally wise, when we are talking about directions, basically, I want SPY trends to remain strong, because then when the market goes down, it can be a good signal. But UUP, it makes it a bit harder, especially when I want to initiate some positions in the future. So first, I hope that first I want to see reversal, and then I will see what Hurst exponent is doing. But basically, yeah, XLY, XLF, UUP, XLB, things like IWM and gold has a very strong Hurst exponent. So again, IWM for me, when I do the check marks in my head, I mean, it makes me more and more willing to short that thing. But of course, in this chop regime, because overall, based on correlations and longer term Hurst, we are in a chop regime for now. So I would not short it naked. So of course, yeah, using it in a spread on a short side is very, very attractive, at least for now. Yeah, so that's what I'm looking at. So I want correlations to go up, and I want to short the market. But of course, all the signals are telling me that it would be stupid to do it immediately.
Buy. Would you short gold right now?
No. No, I don't think that shorting gold is very, very attractive idea right now. But good news is that I don't think that it's a good idea to buy it, especially after what happened. And we all know what happened. But oh yeah, and from the range perspective, no, definitely I would not short that. No, not today.
Even the long-term range?
Yeah, long-term range looks better. I know, I see, but no. Why you want to short it immediately now? It can be a good idea, but what are your thoughts on that?
Well, I was really short gold back on February 2nd, bear capitulation day too. So it's like the same perspective. It's just more Fed hawkishness. Like we're now coming out of the banking thing. Economic data is going to keep coming in hot. We've got the PMI reports next week, which should squash gold, support bond yields and dollar. And then I really like the fact that Hurst was so big. I mean, yeah, it was up today, so that's not good for tomorrow. But tomorrow we got the PC numbers as well as European CPI, so those could potentially hurt gold and get it trending lower. So I like the Hurst was so big, and then I'm just a sucker for when the long-term range and the near-term range are the same. It just
yeah, I understand.
It works every time, man.
And yes, I also like that setup. I just don't see the reason for me to play, especially gold instead of some other plays in the market. But yeah, when a longer term and shorter term range is capped, it's a very, very good signal. Yes,
I think what we've also seen is like a lot of the times before stocks start falling, we see bond yields bottom and we see gold top too before stocks really start going. This happened in February as well. It's happened at prior highs too, if we're trading like inflationary risk off. And so like under that perspective, I'd rather be short gold than short stocks right now, for example.
Yeah. When you put it this way, being rather short gold than stocks, yeah, I can't argue with that.
Yeah.
Yes. So 2 weeks ago, you guys had a bet about VIX, right?
Yes,
It
was,
So how it how it went?
it was whether VIX would reach 40. Everyone in the call was dooming. They thought that the entire thing was going to blow up. Bryan was the only one who said no. So Bryan wins.
Yeah, awesome. Okay, so, I don't know. Anyone wants to add anything to the conversation before we finish, or do any bets? Or
I think there's no way to be bearish or bullish on bonds right now. Ramadan was talking about being bullish on bonds, and now I know he's not here to defend himself, so I can start talking about it. So the Bond Bull Anonymous hotline will be reopened soon. You should not be buying duration right now. You should not be buying gold right now. It doesn't make any sense, especially now that stock bond correlations are starting to re-strengthen. So let me remind you, whether you think there's a recession coming, you're bearish on inflation going lower, you're bearish on growth, these things don't matter for bonds. You have to think about bonds under the perspective of where will Fed funds be over that duration. If you're looking at being long the 10-year bond, what you are expecting is what that current yield is the market expectations of where the Fed funds rate will be in 10 years. You're long the 5 years, where it'll be in 5 years. You're long the 2 years, where it'll be long in 2 years. Think about it like this. Don't think about it in terms of where inflation is going, where growth is glowing. That's what whacked me last year, because inflation was decelerating in the second half of the year. Growth was decelerating in the first part of the year. And being long bonds was an absolute disaster under that environment. And it's the exact same now. Yes, inflation isn't necessarily reaccelerating aggressively yet, although maybe it will, we don't know. But at the end of the day, inflation is sticky high at 6. It's not dropping off like a truck. Oil just recaptured all of its gains. And the reason why oil blew up wasn't because demand was being destroyed in oil. It was because a bunch of hedge funds were long oil and short 2-year bonds, and that trade got completely blown up. That's why oil dropped. It wasn't like some massive recessionary, deflationary risk-off event in oil like we saw in COVID, for example. So that's why oil is down. So inflation, and you look at copper has done the same thing. That's completely recaptured a lot of its gains. It's dripping higher. So like inflation is staying sticky end of the day. And the Federal Reserve is not cutting rates. And again, just like into February 2nd, bear capitulation day, the risk is that the Fed has to be more hawkish than current expectations. The current expectations are for a 60% probability that the Fed does not, I think it might have dipped down a little bit today, but broadly, when I looked yesterday, 60% probability the Fed does not hike at the next meeting and the meeting after that. If you go back and you look on March 8th, it was a 81% probability that the Fed was going to hike 50 basis points this last meeting. That was the big flip that pressured bonds. And then the banking event flipped that on the head. And that's why bonds bid. It's not bid because there's now expectations for inflationary risk off because there's recession. It bid because expectations for Fed hikes went down. So if you're long bonds right now, you think the Fed is not going to hike at all anymore. And there will be more expectations for cuts. That is the only way you can be long bonds right now. And in order to see that, we need to see people getting laid off immediately. And jobless claims are going nowhere. And we get an NFP report next week. And I think it all just re-hikes up expectations, or at least for stickiness. So yeah, you can't be long bonds right now. And as soon as I get a signal to do so, I'll be shorting them pretty hard. And in the meantime, I'm short gold, which is the same play. So little spiel on bonds there.
Yeah, and I agree with you totally. But I said to Ramadan before the show also that in the longer term, basically totally with you. But in the short term, it was, and maybe for a couple of days, it still is better to be long bonds than short bonds. If you want to do that, I would choose to just not have a bond position at all, because I don't want to go long bonds. But in the short term, it played not that terrible.
Yeah, well, and on top of that, if you look at TLT over QQQ, that spread, it's kind of attractive, I'd say. So if you're long TLT, short QQQ, I think it's got some long-term upside in MFR. So not horrible, but it's just like there's just no point really to be long bonds right now. And the risk as well, just like before the banking thing, which again screwed everything up, before the recession, we see the reversion of the 10-year and the 3-month yield. This was happening before the thing, and then it stopped. And I think we still, as the data continues to come in hawkish and inflation remains sticky, we see that reversion of the 10-month and the 3-month. And since the 3-month is going nowhere, although it did just dip a lot because now the market is expecting cuts sometime soon on the short end, that thing is likely going to have to revert here soon. And it's going to happen with the 10-year going higher. Right now, it's at a negative 130 basis points. So a lot of people bought the dip in bonds in January, got wrecked and stopped out in February. A lot of people just bought the dip again in bonds, and they're about to get wrecked again. So on this, and like signals aren't really telling me this right now. Although if you look at the yields buy and MFR, the long-term downside isn't that great on the yields. So signals aren't really telling me that. They're still bearish in MFR. So like they could keep trying to go lower, but from a macro perspective, there's nothing to help you. There's nothing coming unless people immediately start getting laid off tomorrow and jobless claims didn't help you today. And then we have the NFP report on Friday. There's nothing to save your bonds right now. So either they keep chopping and maybe you can get a month of a yield, or they start selling next week.
Yeah, agree. Monitoring them very closely. And yeah, regarding combining TLT with QQQ also, I just looked at the spread and looks interesting. Anyone wants to add anything before we finish?
Good, bye,
What's
thanks.
the we gotta do a new bet. You pick it, Vi, since it's your first day back.
Yeah, Robbie, you wanted to say something, I believe.
Oh, no. I was just saying nothing to
Okay.
add.
Yeah, got it. So this one will be quite boring, but oil in 2 weeks. So higher, lower, and if you have any level in mind, also, so we can use USO or futures contracts. It's up for us to choose, but one bet can be for oil.
Oil is higher in 2 weeks for sure. And I think it is at, let's see here, 77.15 on CL.
On a CL, oh, okay.
Yes.
Yeah, so let's use CL, yes. Totally.
77.15, and it's higher in 2 weeks.
77.15, okay.
I'll write these down in the chat.
Yeah. I'll say that it's higher at 79.
I'll go lower at 70.
Yes, nice.
All right, I'll go with, it remains kind of neutral. I go with 74. So
Okay, 74, cool.
All right.
And another one, because of course everyone is interested about that. So euro dollar in 2 weeks. We can use spot rate, no need for futures or anything.
Your USD is lower in 2 weeks.
Yeah, okay. Any level?
1.074.
Awesome. Not that lower. Okay. Yeah, good one. Okay, I will say lower at 1.0750.
I won't say
Higher at 1.12.
Nice. Okay.
Wait, Vi, what was your level?
1.0750.
1.0750. Robbie, what was your level?
Higher at 1.12.
oh, that's hard for me, these short-term things.
Oh, yeah, that's why we're doing
all right.
it.
All right, okay, let's go. I say goes lower to 1.7. 1.07.
Okay. Yeah. I still I just want to test my level at 1.1050. I'm still confident that euro dollar will go a bit higher. Yeah, but I want that level to hold. That's why I'm saying that euro dollar will be lower at 0.0750. Yeah. Anyway, so thanks everyone for watching. I hope this talk was useful. Feel free to send us any questions you have on our Twitter or next time here in the chat. So thanks everyone. Thanks Christopher, Brian, Robbie. Thanks for Ramadan, who is not with us anymore. So Raphael was out. Maybe he will be here in 2 weeks. So yeah, thanks again. Bye.
Bye.
Thanks, guys.